Have you ever wondered where big corporations and the wealthy names we see in the headlines keep their money? Today, we're going to take a clear and simple tour through 10 jurisdictions that often appear on that map. I'll explain why they attract capital, what they offer in 2025, and what risks they pose for companies, investors, and everyday citizens. If you want to truly understand how international money works, subscribe to Global Finance 360, hit the bell, and stick around. This will help you see why taxes and transparency matter, and why you shouldn't be fooled by magic solutions. Let's start with Panama. For many people, Panama used to be synonymous with offshore companies thanks to its ease of registering businesses, quick procedures, low costs, and a legal framework that allowed international operations to be moved around with agility. The story shifted a bit after the Panama Papers. Public attention and international pressure pushed Panama to tighten controls and cooperate more in the exchange of information. Today, it's still a key logistical and financial hub in the region, very useful for trade and services, but no longer the opaque hideout some imagined. The takeaway: ease and speed still attract, but in 2025, transparency is increasingly mandatory. Now let's move on to the Cayman Islands. If you hear talk of investment funds or major financial vehicles, it's almost certain this name will pop up at some point. The Caymans serve as the home base for many funds thanks to a very favorable tax regime and an efficient infrastructure for the financial industry. This setup allows, for example, a fund receiving investors from different parts of the world to have a simple operational structure. But here's the catch. New global regulations and stricter processes mean that operating from here today requires documentation and controls that weren't asked for before. It's not illegal, but it's an environment that demands administrative transparency. Next up is Luxembourg. Here, the scenery changes. It's not a remote island, but a small European country with massive financial capabilities. Luxembourg has managed to attract funds, holdings, and transnational vehicles thanks to its combination of legal security, specialized professionals, and rules that, until recently, were highly efficient for certain operations. In 2025, the focus is no longer just on paying less tax, but on structuring operations with real offices, employees, and genuine activity. Now Luxembourg competes by offering stability, EU access, and compliance, not simply low rates. Switzerland deserves a mention of its own because it's been associated with banking and wealth management for decades. In the past, banking secrecy was the law. Today, that secrecy is very limited, and Switzerland has had to open up to the automatic exchange of information. But its real strength lies elsewhere: quality of service, legal certainty, and a highly advanced financial system. That's why many wealthy individuals and families with international assets still value Switzerland, particularly for sophisticated wealth management services. The warning here is that reputation is everything. Any opacity scandal now can cost dearly in both fines and image. The next stop in this section is Ireland. You might know it because of the large tech companies with headquarters there. For years, Ireland offered a combination of low effective taxes for certain types of business, treaties, and a skilled workforce, an irresistible mix for multinationals. In 2025, that advantage has been tempered by international reforms. The idea of a global minimum tax reduces the reward for shifting profits solely to pay less tax. Ireland has adapted its regime to remain attractive, but today the message is different: transparency, real investment, and proving that the economic activity actually exists in the country. Singapore is a story of order and reputation. It is not a secret haven. It is a serious, modern, and highly efficient financial center. Companies choose it for legal certainty, political stability, and a banking system that works quickly. Singapore also offers competitive tax regimes for certain types of activity and makes it easy to bring talent and capital into Asia. In 2025, it remains attractive because it offers something many small jurisdictions do not: strong institutions and access to the region's emerging markets. The warning: Singapore has adjusted practices to align with international standards, so today the tax advantage goes hand in hand with requirements for real economic presence. For companies, the advice is clear. If you plan to operate there, make sure you will actually develop activity, hire staff, and take decisions from Singapore. A postal address alone will not be enough. Hong Kong has been for decades the gateway to China and the Asian market. Its straightforward tax system, developed capital markets, and ease of setting up a company made it a favorite for traders, investment firms, and holding companies. However, in recent years, political and regulatory changes have created some volatility and added compliance requirements. In 2025, it remains a key point for operations in Asia, but companies and people using it must weigh two things: the current regulatory environment and the reputational impact. For those considering Hong Kong, the key is to evaluate legal stability, banking access, and the network of treaties available to avoid surprises. Bermuda is a typical niche case. It has positioned itself as a giant in insurance and reinsurance. Many insurance companies and funds domicile there because the local ecosystem understands those businesses deeply and offers favorable tax structures. If your activity is related to insurance or complex financial vehicles, Bermuda can offer technical efficiency. But do not confuse efficiency with impunity. After international reforms, operating from Bermuda requires transparency and very strict controls. Also, the global financial market now demands more documentation to prevent anti-money laundering risks. In short, useful for specific businesses, but with the obligation to document and justify every step. Small in size, but big in services. Liechtenstein was historically chosen for family structures, trusts, and wealth management. Its legal system enables technical solutions to plan succession or protect family assets, and its cultural and legal proximity to Europe makes it convenient for European fortunes. In 2025, Liechtenstein still offers these services, but under much stricter transparency rules, registers of beneficial owners, and more information exchange. If your goal is legitimate wealth planning, for example, protecting an inheritance and organizing intergenerational transfer, it can be a valid option. If the intention is to hide assets, the doors are far more closed today, and legal and reputational risks are high. The Netherlands do not fit the classic idea of a tax island, but they are heavily used by European multinationals, regimes for holdings, bilateral conventions, and a treaty network that makes coordination between subsidiaries easier. The practical advantage is often legal certainty and the ability to structure international operations clearly. In 2025, the Dutch profile has changed. It is no longer so much a shortcut to cut taxes without justification, but a place for structures that demonstrate real economic presence, offices, employees, and actual decision-making, and with clear rules. Moreover, Dutch authorities increasingly apply tests that verify genuine business activity before granting tax benefits. If your company is considering the Netherlands, focus on proving that decisions are taken there and that real activity occurs. Having reviewed the 10 countries, what can we take away? First, many of these jurisdictions provide legitimate features that companies and wealth holders value. Institutional stability, market access, sector expertise, or an administration that facilitates international operations. Second, the big change in recent years is that transparency stopped being optional. Automatic information exchange, registries of beneficial owners, and a minimum tax have rewritten the rules. That is why today the key concept is real economic presence, having real offices, employees, demonstrable activity, and decisions taken where the operation is declared. And what risks should you watch for? For main ones, legal risk. Authorities can challenge structures that lack economic justification. Reputational risk. Being linked to opaque schemes can damage your brand. Operational risk. Banks now ask for more paperwork, which raises costs and delays processes. And future tax risk. Rules evolve, and a benefit today can vanish tomorrow. If you manage wealth or run a company, here is a practical, fully legal guide. First, define your objective: tax efficiency, market access, or specialized services. Do not base your choice only on the headline tax rate. Evaluate institutional quality, treaty networks, and legal protection. Document everything: contracts, minutes, receipts, and compliance policies. And finally, get advice from licensed, reputable professionals. One final important idea: when large companies pay less tax, states collect less revenue, and that limits funds for health, education, and infrastructure. That is why there is public pressure for more transparency. For responsible companies, competing with transparency is the most sustainable path. For citizens, understanding these rules helps demand a fairer system. If you like this tour and it helped you understand how these jurisdictions work in 2025, share the video and subscribe to Global Finance 360. Leave a comment telling us which country you want us to analyze in more depth or which case you'd like explained. Stay informed and act responsibly. See you in the next analysis.